All right, looks like we're live. Today is Thursday, January 19th. We have initial jobless claims in 9 minutes. It's been a good day overall. Overnight has been amazing. My account size is up. We have the market selling off, which is what I position myself for. Minus 1% on the NQ, minus 0.8% on the ES. My ZQ position isn't as bad as it was last night, so it's getting better. And we have data coming in 8 minutes. I'll be right back. Alrighty, so 8 more minutes. I have a few feeds open just to see what the news is saying about the data. Let me just fix a few things for my stream as well. Alrighty. Let's go here. All right, the NQ is going up. So is Microsoft. What's going on? All right. Okay, so everything seems to be ready on my end. Got data coming in soon. So we're looking at the jobless claim. They're expecting 214,000, and previous was 205,000. So let's see what happens. So markets are gonna probably make a big move depending on what we get here. Microsoft is going up, ZQ is going back up. I almost feel like buying a call spread on NQ just so I can make some money in case the markets rally, because I'm positioned more for a sell-off than a rally. But if it does rally, we'll fade it maybe. Taiwan Premier resigns. Interesting. So did the New Zealand president or prime minister. 6 minutes until data. Hey Jack, yeah man, so are mine. Mine are printing too. I'm up 1,000 today. That's amazing. Hopefully it does sell off still. Hold on, I gotta fix another thing with my stream. I forgot something. Hopefully we sell off some more, but we might get a fake out that we have to fade, but who knows, right? See what happens. I always assume that I'm not gonna get lucky because that's why I sell premium, because I'm not the luckiest person. I don't rely on luck. When you sell premium, you don't need to be as lucky. But I throw in a few trades here and there where I can benefit from luck. So hopefully that happens. All right, everything is set up now, finally. All right, 5 minutes. See what happens. Anything can change once the data comes out, because the job data is super important for Fed rate decisions. Too many windows. All right. I do want to hold these till sometime next week. It's probably a good bet because the move we had yesterday was sharp. It was really, really sharp. Markets are wanting to sell off, it seems. So we got Microsoft here. Maybe I should watch another stock. What do we have that we can watch instead? Netflix, maybe Tesla. Tesla is super bearish. Tesla might sell off like crazy. Although Tesla's pumping more than any other stock right now. The JPM COVID thing. Yeah, that's it. That's a good call. All right, 4 minutes till data. Let's see what happens to the NQ. I might jump in with a buy or a sale. I'm at my all-time highs, 408K, definitely all-time highs. All right. The ZQ is trying to pump. That's gonna lose me some money if it pumps too hard. Three minutes. All right, so if it comes in too hot, then that might be somewhat bullish. If it comes in too cold, like if the number is too small, that is probably very bearish, because it means the Fed's going to have to keep hiking higher for longer. If it comes in really, really hot, then it gives them more reason not to hike anymore, or to just wait and pause or whatever. And it's going to really affect ZQ. That's why I'm watching it. 2 minutes. Yeah, that's the main idea. But you never know. The market might tank no matter what, or it might just go up no matter what. Market makers do what they feel like. But yeah, that's the main consensus. 1 minute until data comes out. That's why I'm shorting ZQ, because I think higher for longer is going to be a reality, and the markets are kind of really hopeful that it's not the case. They're in denial, that's the thing. Yeah. All right, so less than a minute. See what happens with the markets. Tesla's still pumping here into the data. All right, it's coming out soon. Hopefully we get a dump. All right, a few seconds. Tesla's still pumping. All right, we got it in. Let's take a look. Oh, wait, I don't have that one yet. I have housing starts. Housing starts are down. Building permits are down. Markets are selling off though. I don't have jobless claim. ZQ was selling off. Where's the jobless claim? Jobless is in 190. That is cool. That's super bearish, guys. 190 is cool. That's probably bearish. Maybe just short this here. Okay, I shorted Netflix 25 shares. See what happens. I'll close it if it doesn't sell off. But 190 is cool. That means higher for longer. Maybe. We'll see what happens. See how the market interprets it. What else is there? Business conditions are pretty good, actually. 4.9. I don't know what that means, but it looks good. Employment 10.9. They were predicting lower employment, and it's 10.9 for Fed employment. I think we're selling off here. I think we're selling off. 1647 continued jobless. I don't see that one. Oh, here. Continued. Yeah, that's not a big difference. It should increase. Look at the Fed funds. It's going down. That's going to actually allow me to break even or profit. Because now they're going to price in higher for longer because jobs have not gone down. Looks like shorting Tesla was a good call. And we're still selling off here. Look at the NQ. I can take profits off of this Tesla short or just keep it. Keep it for a while. That's only $9. So higher for longer is going to be a reality. ZQ should sell off too. Hopefully ZQ sells off so that I can take profits later today. Looks like a nice move. That's a nice like $200 move or so. Yeah, this is overall bearish, but not too bad because everyone was expecting the jobless claims to go up and give the Fed a reason to cut rates and achieve a soft landing, but it looks like they'll have to keep the rates high. Tesla's going back up. Should have taken my $5. And what else? Housing starts are down, but not by much. They were down more last month. That means that the housing market is still pretty hot. I should maybe just close my Tesla short. But ZQ is really good. ZQ definitely helping me out. I was down by 200 last night on ZQ. Tesla's coming back up. Shorted the wrong stock, eh? Although it's moving similarly to this. But ZQ keeps going down. That's good. I'm finally green on my ZQ. And how's the SPX? Okay, that's good. Minus 0.9%. All right, let's see what they say.
That onion. It's really not a question, I don't think, anymore of 25 versus 50 at this next meeting. They want to be careful as they go forward. 25 seems baked in. Pretty much everybody on the Fed is talking about that. So I wouldn't be surprised if he says 25, but let's see what he says about the terminal rate and Lael Brainerd, because she's been perhaps the most dovish
in a cumulative
on the
way.
Fed in a cumulative way, saying we're going to have a lot hitting the economy, and maybe we're starting to see that, and we need to be careful as we go forward. This is going to be the interesting thing.
Very interesting to see here, and of course yields move higher here nicely. 4.11 and the 2-year yield shows the movement of the morning. This is a great honor. We're going to do this, and McKee's going to talk to the outgoing head of the Kansas City Fed here with a real competence of public policy. Mark Giannani joins us right now. He is with Barclays. He's chief U.S. economist, but far more, his academics is entrenched in the debate of the moment. Years ago, a guy named Olivier Blanchard said this 800.
All right, looks pretty good. I'm going to be right back.
It's the book no one except Giannani has read. It's called Interest in Prices by Michael Woodford. And when you were at Princeton, you were esteemed under Professor Woodford, now up at Columbia, and all that. And it's a knowledge of the underlying theory of what interest and prices do. To people like you, or Ben Bernanke, or Michael Woodford, do you have a theory right now that's operative, or are you flying blind?
Well, I think good morning, and thank you for having me. No, we think of the framework basically that got described in that textbook and developed in that textbook really underlies a lot of the thinking among monetary policymakers across the world. I would say people think a lot about the monetary policy through the communications of the Fed and other central banks, through the effects of policy actions longer term as well. I think
what's going on with the dollar? Dollar's unchanged, so that's good.
Is a direct implication of the framework developed in
the
textbook.
Netflix doesn't want to give me profit. I might just close it.
by central
I
banks,
don't need to
certainly
play
here in the
short
US and
here.
around the world.
We're in the continuum
We'll
from
wait
a
a little
COVID
bit.
shock, a medical disaster, and all the supply side, not supply side, but supply dynamics back over to traditional Fed theory. Where are we in that timeline right now?
I think we are very much revisiting the more normal dynamics now. There's a lot has been very unusual and very unique with the pandemic. But what we are seeing now is a classic tightness in the labor market, having where labor supply is fairly limited and labor demand is really, really strong. And that results in substantial wage growth. And the classic tool for policy here is to keep raising interest rates and tighten policy in order to tame that labor market and try to bring the economy on a more sustainable path so that inflation returns back to the 2% target. So I think this dynamic is something that we've seen over time. We've seen certainly back in the 70s and 80s, and now the Fed is using those tools again.
The trend of disinflation that we have, and a disinflation coming down with great rapidity, do you at Barclays feel central banks are behind the rate of change of disinflation back to something near normal?
So we do think here that inflation is going to come down pretty quickly, both when we do certainly when we do a bottom-up approach, looking at the individual components of the CPI,
Tesla's going down.
Later, and also looking at top-down with the tightening in policy that has taken place last year. And it's going to keep having an effect in coming months. So we do see and expect inflation to come down pretty substantially this year and likely below 3% by the end of this year.
The outcome of this off a Phillips curve analysis is, I guess, unemployment migrates from 3.5%, and you would suggest out to 4.5%. I think our viewers and listeners would say that's an abrupt move, where others like James Bullard and Bill Dudley, even Mohamed El-Erian, saying that's normative, that we should see a 1% move in unemployment. What are the consequences to the public of a move from 3.5% to 4.5% unemployment?
Yeah, I think it's going to feel very different by the time we have the economy slowing, as we are seeing some survey data sort of suggesting now, and you pointed out earlier on your show, the retail sales data being pretty weak as well. We expect more weakness coming in. So far, the latest data we've seen is probably more affected by weather as well and other special factors, but we expect more slowing coming in and the unemployment rate to gradually increase. And we feel like in several months from now, when the unemployment rate is a higher level, together with inflation also coming down and wage growth moderating somewhat, is going to feel a lot different. And in particular, if rates are at a higher level, short-term rates probably going up another 25 basis point at this meeting, and then followed by another 25 basis point in March, and is going to bring a very different constellation of macro factors.
You know, I find what's fascinating here, and folks just joining us here on radio and television, Mark Giannani with us with Barclays, with this wonderful dovetail of academics into market economics as well. The sum of all our fears right now, Dr. Giannani, what's your biggest mystery for 2023? Not so much the doom and gloom of your biggest fear, but what's the unknown as you synthesize last year's debacle in the markets? What's your unknown right now?
Well, geopolitical issues is always some very big source of concern, I would say. But I do think something that appears unusual now is really this labor market that continues to roar back and signal after signal that comes out from the labor market, including this morning's jobless claim, suggests really a labor market that keeps roaring ahead, and how that really line up with the overall economic activity slowing. So I think there are a number of factors that are new here and that are emerging and that are no.
Well, Dr. Giannotti, thank you so much for joining us with Barclays. Thrilled their chief U.S. economist could join us this morning. A little bit of an academic exercise there, but I thought we could move to something different than the debate of 25 to 50 beeps. And as John Farrell mentioned earlier this morning on Market Economics, Citigroup comes in with an adjustment from a 50 beep call coming down to 25 beeps, 0.25% move there by Citigroup. Futures are negative 32, Dow futures negative 263. I see that looking at the Morgan Stanley billboard outside their office here in Midtown Manhattan, which means in Davos, Switzerland, are David Weston with their leader, James Gorman. David?
Thank you so much, Tom. Well, I'm here with your co-anchor, Lisa Abramowitz, and we do indeed have James Gorman, the chair and CEO of Morgan Stanley. So, James, thanks so much for joining us here in Davos. Your earnings came out. Everybody pay attention to them. And I heard a story, you can tell me it's true or not, that once some time ago, you were recruiting a senior executive and said, you know, wealth management may not be as exciting, but over time you do better, more steady. Is that what we saw? I noticed your stock went up 6% when Goldman's went down 6% the same day.
Well, firstly, thanks for having us. You know, it was a good day because I told our board a couple of years ago what I'd really like to see, selfishly, is a very difficult environment. I don't want to see it for the country. I mean, it's not fair, but for Morgan Stanley, because I wanted to prove the business model would do fine when things are really difficult. And in fact, we had our second best year ever in revenues and net income, third best in.
Looks like markets are not selling off, but I might just hold this short position and see what happens at market open. ZQ's coming down slowly. That is good for me.
Trading and the like. But what we proved is by having, you know, between $5 and $6 trillion of people's money under management, that is stable. And that was the design 12 years ago, and we've got there.
One thing that you said was you are planning to expand some of the wealth management aspect, even as you cut back other parts of the business. You acquired E-Trade, Eaton Vance. Is there another acquisition that you're trying to target, or is it going to be just sort of organic growth?
No, I think it's a mix of both. I mean, we started off with Smith Barney 14 years ago. Then we acquired a wonderful little company in Calgary, Canada, called Solium, which did all the sort of workplace stock plan businesses for a lot of the S&P companies. Then we bought E-Trade, then we bought Eaton Vance, and we bought Mesa West, which is another company. So we've been building them, and as opportunities come up, we keep acquiring those spaces.
Is there room for another large acquisition?
There's always room, but we like things that aren't balance sheet intensive. We like things that help grow scale in spaces that we understand. And, you know, we like things when we know what the capital picture looks like. So, at the moment, we've been quite aggressive with our buyback. We doubled our dividend 2 years ago. We increased it 11% last year. But we're also dealing with changing regulatory environment. So you're managing between what are the capital demands regulators require, how do you distribute it through dividends and through buybacks, and then what do you need to do to invest in the business, and part of that investment, of course, is acquisition. So it's a multi sort of chess game that we're playing.
James, you said it was there were some difficulties, and you were happy that you could manage through those difficulties and show that your model works. Some of the difficulties were some highly leveraged loans for some acquisitions and things like that. Yeah. Is that crimping your ability going forward to make some of those highly leveraged loans? Are you changing the risk calculus?
No, we've been, I would say, conservative over the last 2 years. In fact, it was September a year and a half ago, that I met with the management committee and said, let's all just pull it in 5-10%, right? And our RWAs, our risk-weighted assets, actually declined at the end of the year. So we did that. And so within the leveraged loan space, again, a little conservative, but we have a large portfolio. Obviously, you're going to take some losses in these markets within that. They're absorbed in our numbers, but you're also generating a lot of interest income, a lot of fees on it. So in balance, David, I think we're reasonably well positioned, but we're definitely not trying to be aggressive in this environment.
There is one high-profile loan that might rhyme with Twitter that we're going to have to talk about. The Twitter loan that I know Morgan Stanley led on. Could Morgan Stanley end up owning Twitter?
Could mortgage that? I've never been asked that question. No, we could not end up owning Twitter.
Do you plan on offloading those loans, or do you just plan to hold them?
Firstly, Twitter's a great company, and let's be fair, Elon Musk is one of the greatest entrepreneurs and business people, in the last century, and that's under.
Yeah, and he's probably also a fraud.
Company alone, let alone SpaceX, let alone Tesla. I mean, this person has extraordinary capabilities. Twitter is a great company. Obviously, it's gone through restructuring. It's part of our. I'm not going to talk about the specific loan position we have, but we're very comfortable with our position.
So there are a lot of things we don't know about the economy going forward. One thing that people seem to be reasonably confident is the rates are going to be higher. Interest rates are going to be higher than they have been in the past. How does that basic fact change your business? How do you manage your business differently when you've got rates at 4, 5, 6% instead of 0 to 1/2%?
Well, we had an artificial environment. I remember when I came to the United States. I mean, obviously, as an unsecured student, I wasn't a great credit, and the bank loan reflected it. I paid 24%. My first mortgage was 14.5%. So we've lived in a surreal world for a decade, which is the legacy of the financial crisis. To get the economy back to where it was, central governments around the world kept rates near zero. Then along came COVID, which delayed what would have been a natural rise in rates globally. Then along came the Russian invasion of Ukraine, which further delayed it. Finally, you turn the corner in 2022, mid-22, when the Federal Reserve and other central banks around the world, not by coordination, just by need, had to normalize rates back to neutral. They've gone higher than that. They had to go higher in order to take some of the fluff.
All right, ZQ's coming down. Tesla's coming down. My ZQ position is now almost $100 up. I'll keep it a while longer, maybe till like 150, and then I'll take the profits.
Well, we benefit in net interest income in the wealth business. We manage over $300 billion of deposits, and rate volatility obviously helps your macro trading businesses in foreign exchange and rates. It hurts companies wanting to do deals because the cost of financing is higher. It hurts your margin loan business. People bring down their margin loans because it's more expensive. So there are gives and gets, if you will. But what I loved about the performance of the business last year, which again wasn't a record, but was a great year, was that with those gives and gets, we came out in a position of 15% ROTCE and attracted over $300 billion of new money from clients.
Here at Davos, there seems to be an incredible amount of optimism, and people have noted the shift in tone and that suddenly things seem to be moving around the corner. And I had asked you, do you think it's overplayed? You said you're the most optimistic person you know. So why are you so optimistic? What does optimistic look like here?
Well, I've seen a lot of cycles in my career, and I've seen some really, really dark periods. The financial crisis after September 11. Even though, the early recessions in the US in 93, 94, the market bust in 87, I go back, I'm a lot older than you, I go back a long way. And, I think what we've been through, if you stack up the negative stuff that happened, first land war in Europe in 40 years, first global pandemic in a century, first land war in Europe in 70 years, first global pandemic in a century, and highest rate increase because of inflation in 40 years. That's a lot to throw at people. And where are we now? It's not bad. The debate is, will it be a recession? Will it be short and shallow? Nobody's saying we go into depression, right? Everybody's saying we can kind of deal with this. And two things I think have changed in the last month, which has caused this echo chamber we live in here in Davos, where everybody's basically repeating back to each other what they've heard from the last person. Let's be honest. I'm not, hopefully, but most people are. Two things have changed. Number one, the inflation numbers are there's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean that you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more sober discussion around global trade relations, and right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
We've come all the way over to Switzerland. I'm struck at least by the fact that there's all talk about Washington, particularly the debt ceiling. A lot of concern. I hear two things. One is it's ridiculous, and two is it would be catastrophic. What is your reaction to that debt ceiling? How do you take into account the possibility of a U.S. default?
Well, was it Churchill who said the Americans eventually get it right after, and I can't remember the exact quote.
Alternative.
Yeah, so I'm confident that politics will finally get to the right place on this. I'm confident about that, because the other option is just not an option.
One thing at Davos that people have also been talking about is the new normal for work from home. We heard a bit of a retracement from Citigroup in an interview that David did here with Jane Fraser. What's the new normal? Is it coming into the office 4 days a week? Is it flexible? Is it work from home more freely?
I think it's very, very specific to what you do. If you're a tax attorney who doesn't work with other teams, then obviously you can spend a lot more time by yourself. Doesn't matter if you're in an office or not. I mean, there are different kinds of jobs is where I'd start with. The main point is, post-COVID, we learned you can function. I ran Morgan Stanley for 3 months from my home office, right, with 73,000 people. So it's pretty remarkable. We proved you actually can do it by not going into the office. But should you do it by not going to the office? Now, that clearly, to me, the big answer to that is no. We won't put the genie back in the bottle. 5 days in the office for everybody is not going to happen again. For some people, of course. And at Morgan Stanley, we're kind of business unit by business unit. It's 3 or 4 days in the office. My rule has always been on this: if you're not spending a majority of your working time in the company of your colleagues, you are missing out on mentorship, on development, on EQ, on just reading the signals of being in a meeting and watch how people handle the stresses that go on and the unspoken body language and so on. So it's 3 or 4 days a week. I don't think that changes in a hurry. Some people in some businesses, our trading floors are cheek to jowl. You go in there, they're 5 days a week. So it's very business specific. But my golden rule is, don't put the genie back in the bottle. You can't. On the other hand,
all right, markets are pumping. NQs at the highs of the morning. The highs of pre-data.
I want them with
but maybe this is a fade.
At least 3 or 4 days.
So, James, you've talked about some of the responsibilities of the CEO, which are formidable, allocating. Right there, people sitting around corners. One of the jobs is succession for every good CEO, and we've seen it done well, we've seen it done not so well. A couple of years ago, you said maybe 3 more years. How do you approach the question of succession? How do you set it up for the good of the institution of Morgan Stanley?
Very intentionally. Firstly, you should always have a sort of an envelope for, God forbid, something horrible happens. We've done that from a very first board meeting in January of 2010. But more realistically, you plan a generation of people who can take over. We at Morgan Stanley have now 3 executives who can replace me. They're all very, very talented executives, and we're trying to fill out their skill base, and ultimately the board will decide who is the best qualified to run our particular company at this point in time. I'm extremely intentional about it. I would definitely step down. I'm not going to stay in this job for life. I have no interest in that. And it's unhealthy for our the way we're constructed, right? We've got to focus on what's right for Morgan Stanley, and it's to grow the next generation. I work on a 10-year and 20-year plan in talent planning. And that's how far out I'm thinking about it. And, I've been in this job, this is my 14th year, so I've had plenty of opportunity to develop folks. And the great news is, David, we've got some unbelievable talent.
James Gorman, thank you so much for being with us, the head of Morgan Stanley. Tom, back to you.
Lisa Bramwitz, thanks so much. I noticed there with the really interesting comments from Mr. Gorman on work from home that Bramo this week.
That was a good interview. I never heard that CEO speak.
From Davos, and we'll have continued reports here through the end of the week. I should
Gorman.
point out David Weston with Wall Street Week. Look for that, a special edition coming from Davos, Switzerland. We'll do that, I believe, tomorrow as well. The world's changed. There was economic data. I've looked at a couple notes while we were listening to Mr. Gorman. Ian Lingen really frames out how unusual claims are. Anyone that tells you they understand initial jobless claims in the United States of America, run as fast as you can, hopefully holding on to your wallet. 190,000 on claims. That is absolutely stunning coming out of this pandemic. Please stay with us through the day. Futures.
That is stunning. I want to hear more commentary about that. The biggest move that happened is the Fed funds rate. Futures coming down. The markets are pretty flat since the data. So yeah. Okay, take a look. Put some beats. So I'm trying to short Tesla again, see what happens. Maybe markets just want to pump today because of the sell-off yesterday. Maybe they're pricing in a pump. Yeah, we want to break out here. It looks like we're breaking out. Maybe today's a bullish day. We still have 33 minutes till the market opens. ZQ wants to go back up. How's my other stocks doing here? My watch list. GME's down. Everything's down mostly. We're pumping here. And Q wants to go higher. It's crazy. Calm down. It's not even 6 o'clock yet. Netflix is down just barely. Nvidia. Netflix earnings tonight. That's going to be a big story. I have no positions on Netflix. I might open one right before earnings. Silvergate. I think Netflix is going to sell off today. I have a feeling that their ad-supported tier is shite. Maybe I'll open like a risk reversal or something like that. Like sell a call and buy a put super far out of the money. And then hopefully they mess up with their strategy and we profit, maybe. Stupid Tesla, just go down. I need the ZQ futures down to yesterday's levels. Yeah, if we can go down to here, it would be great. Bulletins. All right, 6 o'clock. 30 minutes till market opens. Let me take a look here. Take a look at my P&Ls since it updates at 6. All right, so as expected, these 370 puts are my biggest losers. The rest seems okay. The Lulu situation is going to be ugly because of these two. But it should be fine. Overall, I checked my deltas, and my deltas on Lulu are negative, meaning that I benefit from a sell-off. My delta here on Lulu was 21, negative 21. Hold on, let's do this. How do you freeze frame again? Whoops. That's definitely not what I wanted to do. Okay, yeah, that's not good. Yeah, that's what I want to do, okay. I think the way you do it is this. You just press here. I swear, I am a Excel noob. No company would ever hire me for a real job. Okay, there we go. Yeah, now that works. Okay, so yeah, things look pretty decent, I'd say, overall. And then all of these are winners. I opened a lot of bearish positions, and they're all decently winning. And this only gets better with time, because they all carry positive theta. And then I'll have to play a little bit defensive for these. Caterpillar, I wasn't expecting this to be a big loser. Wow. $100 on Caterpillar. A lot of people are bearish Caterpillar, actually. It would have been a good time to buy puts at 270 instead of selling them. 257. That's where we were.
The data today versus the data in 6 months, 9 months, 12 months from now. And of course, the market's forward looking. So the market should not be trading on, today's data. I mean, look at, GDP now, for example. I think it's north of 4% at this point, but rather what's going to happen in the back half of 2023 or into 2024. And I think that's what the bond market's telling you, is that the data's okay today, but it's clearly deteriorating and has been for some time. I mean, you have ISM new orders, PMI manufacturing. Look at Empire the other day, retail sales. Really everything other than labor is certainly weakening. But
Tesla's pumping.
The economy that's running hot, and that formula of a hot labor market with weak other economic data is the perfect recipe for fixed income, in particular treasuries.
So with that in mind, for the same reasons you like treasuries, Mike, shouldn't you hate credit? What business does high yield credit have rallying into survey data that is showing sub 50 prints on the ISM?
It's pretty ridiculous, Jonathan. I mean, listen, I think there's a lot of technicals going on.
High yield, eh?
Market, you've had next to no
That's HYG.
In and of itself, by the way, is a really bad sign. In our default model, issuance is a big factor into our default model. When you have low issuance, you have huge risk aversion. Risk aversion is usually bad for high yield. But perversely, what's happened is most high yield portfolio managers have high cash balances at the moment. They're not paid to manage cash. They're paid to manage high yield. You've got coupons that are coming due, and you got to put that cash to work, and there's no primary market to do it. So it gets recycled into secondaries, and that ultimately pressures spreads lower. That can only last so long in the face of deteriorating.
Let's look at the ES. Everything's down, still down.
On the corporate side, listen, we're about to enter into an earnings recession. Low quality never does well in an earnings recession. So the whole "this time is different" argument, I think, is not going to hold a lot of water. As defaults start to increase, as liquidity remains tight, as you go into an earnings recession, I don't care what the technicals are, spreads are going to widen. But by the way, Jonathan, everybody loves IG. We don't like that either.
Mike, I can see it in your notes. You said this. Why would anyone take credit risk here? So build on that. It's not just high yield. It's IG as well.
Yeah, I mean, listen, I think probably the most consensus fixed income trade out there is investment grade credit. You look at spreads on investment grade, you can own the investment grade market at about now under 5%.
Tesla's pumping. I probably have to close this.
Give or take.
I wasn't expecting such a pump.
50 basis point difference. Why would you take liquidity and credit risk going into earnings recession when I can get lower duration, same yield paper and treasuries. It makes absolutely zero sense to us. And so we really don't like credit here. We think there will be a time, by the way, to own credit, Jonathan. And the fundamentals are not terrible. I mean, balance sheets are relatively healthy, but now is not that time. You need to be compensated for liquidity risk. You need to be compensated for default risk. And in the investment grade side, you need to be compensated for downgrade risk and business risk in general. And so far, you're not.
Zach, it's in your title, investment grade. This is your world. What do you say back to that?
We're taking the other side of Michael's view and certainly appreciate that yields have come down a bit. But when you think about the reinvestment risk of owning a 2-year treasury versus the duration of the IG index closer to 6 or 7, something.
All right,
like
we're
that,
coming down again.
That factors into it. And while he did mention some technical concerns,
ZQ is stable.
there is a lot of cash out there looking for a home. We don't have as negative an outlook on economic growth or earnings as Michael seems to have, and so we think that really the income that you can earn now relative to what you've gotten in the past makes IG attractive, and we think high yield is even more attractive. Again, yields have come in quite a bit.
All right, Tesla's coming back down.
Is solid, and even with a downshift, when you look at the supply and demand dynamics, demand is really coming back from the retail side. You've seen that in the first couple weeks of this year. We think that has some staying power, while at the same time the maturity wall in high yield world isn't a concern, I'd say, in the first half or maybe in 2023 overall. So if markets can remain as open as they've been over the past couple of weeks, we think both IG and high yield will perform well this year.
Mike, have you got to come back to that?
Well, I do, Jonathan. On the high yield side, maturity walls never matter. You look back in 08, 09, as defaults were skyrocketing, the maturity wall was actually pushed out quite far. And so if you go back and look at prior default periods, the maturity walls don't matter. You miss your coupon before you ultimately have to refi your debt and default that way. But listen, more importantly, I prefer long duration, long maturity treasuries. If you think there's any spread widening potential in investment grade credit, then you would rather own treasuries because you're not getting enough of a yield cushion to make up for any spread widening, really. So, much of this, I think, comes down to, who you are as a portfolio manager. What kind of strategies do you manage? If you're an investment grade bond manager or credit manager, then certainly today doesn't look bad to own corporate credit risk. If you can be a multi-asset fixed income manager, to me, long maturity treasuries without the spread widening risk makes a lot more sense and give you equity-like returns.
The Treasury yields this morning on a 10-year up 2 basis points to 339. I'm not trying to start a fight over credit. That would be pretty lame. Equity futures right now down 0.7% on the S&P. Mike McKee's dropped by the studio to catch up with us as well. Mike, before we get to the Fed speak, can we just start with the economic data? Softer yesterday. And then can you please make sense of this? Jobless claims, I'll keep saying it, 190,000.
We have a statement from Fed's Collins here. Policy rate needs to rise to likely just above 5%. Then we need to hold rates for some time.
And there does seem to be no real effort to lay off extra workers these days in a lot of industries. We saw that in the Beige Book yesterday. You mentioned the numbers, and the headline, of course, the one that got everybody's attention, jobless claims 190,000. We did see a decline in housing starts and building permits, and you look at the total number there.
So we have a tweet from Mohammed El Arian. It says, while the weekly U.S. data, Tesla selling off, is inherently noisy, today's jobless claims print of 190,000 will nevertheless attract attention. The print is yet another indicator of the robustness of the U.S. labor market and therefore has some implications for Federal Reserve policy, where the debate about the future path of rates is not just between the Fed and markets, but also within the Fed. All right. So that's why ZQ is coming down, I think. Let's go. Yeah, I need Tesla to sell off here.
Falling. Wages are rising too fast, and the key thing is this 1980 argument.
Just dumb.
Stopped too soon in 1980. Inflation went back up, and we had another recession. Jamie Dimon this morning saying he thinks the Fed is going to go over 5%. They still need to do a lot more, which leaves us with the fight between the Fed and the market. markets. That has not changed as of this morning, with Fed officials still clinging to the idea they're going to go over 5%. Susan Collins of the Boston Fed just seconds ago out with comments that they need to get over 5. They can do it slowly. She's in the 25 basis point camp, but they need to be more restrictive.
Tesla is
And
resilient.
The question is,
why do I
where do they end
freaking
up? They
short
say
the
they
wrong
hold,
stocks all the time?
Markets say they cut.
Yeah.
It's going to be an interesting debate over the next few months.
The pace of the journey for them set to change, but the destination hasn't just yet. Mike, thank you. Mike McKee just there. Let's go back to that. The reasons to stop, the reasons to keep going. Zach, Mike, I'd love your feedback on that. There are several reasons to stop. There are several reasons to keep going at the Fed. Stop. Inflation falling, job growth slowing, retail sales weak, very inverted yield curve. Don't stop. Inflation still too high, unemployment falling, wages rising too fast. 1980. Mike, which is it? Stop or don't stop?
We're in the don't stop camp, but that doesn't mean, Jonathan, that you have to go forever either. I mean, maybe another 50, 75 basis points certainly does the trick, and then you hold and stay restrictive for some period of time. But look at the real Fed funds rate. I mean, the Fed has really never been able to get a handle on inflation without hiking interest rates higher than CPI, and we're not quite there yet. And so I think the Fed needs to get truly restrictive. I agree with Bullard on this. Whether that's 5 or 5.25, I don't know the answer yet, but it's higher than where we are today. The other thing I'll just quickly mention, Jonathan, before, obviously throwing it back to Zach, is I don't know if the level matters. What matters is the outcome. Whether it's 4.75 or 5.25 or 5.5, I think the market has kind of lost sight of what does that mean? If inflation's coming down because growth is slowing, it's the outcome that matters more than the level.
Hey, Zach, jump in.
Yeah, we keep being on opposite sides of the discussion here. We're more in the stop camp, and that's not stop right now. We think 25 more basis points. And when you think about the policy rate in real terms and where we think inflation is going this year, we think by, let's say, the midpoint of this year, you could have inflation running at around a 3%, maybe even in the 2-handle range, with the policy rate, if our call is correct, around 450 to 475. So that's a very real terminal rate in that case, and we think that that's going to be enough to keep inflation down, keep it slowing toward their 2% target and remaining there on a sustained basis. And then maybe at the end of 2023 and into 2024, we can start thinking about cutting rates. So we think the biggest mispricing in the market right now is the very quick shift to rate cuts. We know the Fed has said that's not their plan. They've said it over and over again. The market hasn't budged. So we think lower terminal rate, staying there for longer, and inflation coming down more quickly than perhaps is appreciated by broader market sentiment at this point.
It's January 19th, and I think the consensus has shifted twice already in the last couple of weeks. Neil Dutter of Renmac pointing that out. Neil published just moments ago. He said in less than a week, financial market participants have gone from increasing odds of a soft landing to increasing odds of an imminent recession. Sorry, but the economy simply does not work this way. This is where Neil was at in the last 24 hours. And Mike, I'd love your view on this. This is what Neil's got to say. It's a more constructive, optimistic view on things. He said the manufacturing data were undeniably weak. But why does this continue? Aircraft and autos have a lot of momentum. The dollar sold off, supporting the exports of manufactured goods, and global growth has rebounded. Mike, a final word on that, please.
Yeah, I think, listen, at the end of the day, it is very difficult to see an economy that's going to continue to, or I should say, expand from where we are today, given that rates are restrictive. You saw what's going on with banks. You know that lending standards are the tightest they've been since the global financial crisis. That's not an environment, especially as you go into an earnings recession, where growth re-accelerates. And so from my perspective, I'm not, terribly bearish on the economy. Like I said earlier, the economy's doing okay right now. But, if Zach's right and you got 1.5% real Fed funds rate in 6 months' time, that's pretty restrictive policy in the context of an already slowing economy. It doesn't look good.
We'll keep building on this. Mike, Zach, you're going to stick with us. Equities down about 0.8%. Hearing from the Boston Fed President, Susan Collins, this morning, saying the following: remains optimistic about a soft landing and the odds of one. Says the slower pace of rate increases is appropriate. This is about risk management now for some of these Fed officials. She says a more measured rate hike and that address of a more measured hike from, say, 50 to 25 would help address competing risks. That from the Boston Fed President, Susan Collins. A little bit later, you're going to hear from the Vice Chair of the Fed. You're going to hear from Lael Brainerd. You'll also hear from the New York Fed President, Mr. Williams, as well. All of that this afternoon. Coming up, corporate America, Rennigan costs.
Alright, so we're gonna have a bunch of Fed speakers today. I think ZQ is gonna keep going down because of that. Alright, that's good. So far so good. This has been a great morning overall. And I was just checking Twitter. I saw some tweets regarding the jobless claims.
Why are the Germans once again dragging their feet on military support?
But first of all, I don't agree about the assessment of the Germans. What they did at the start of the war, deciding to ramp up defense spending by 100 billion, immediately agreeing that German gear could be shipped to the Ukraine. They were the ones to open up the Panzer howitzers together with the Dutch and others. So they have done whatever needed to be done. And it's not just the Leo 2s, the Leopard 2s, it's also about other tank systems. But this is a sensitive decision, and I do agree that there is an argument to send them to Ukraine. There's also an argument to take that decision in conjunction with others, including our friends in the US.
Yeah. The cost of the war in Europe is huge. If anyone's had to bear the brunt, apart from the Ukrainian people, it is economically the Europeans more than any other region in the world. Is the appetite still there at a broad EU level? Is the consensus still there?
Yes, and do you know why? Because people feel, not only understand, but also feel that this is about values, that we cannot accept one country invading another country.
They feel it.
We have seen the footage from the Dnipro where children, women, men, families, completely not involved in the war, were hit by rocket fire from Russia. But it is also about our collective safety, because we all know, we have seen this in Munich 38 and so many other spots in history, that if an aggressor is not challenged and can go about his business, it won't end with Ukraine, then the whole West is threatened.
Good thing I closed my strangle.
Well, you talked about the IRA, the Inflation Reduction.
AMC's coming down.
I talked to a lot of CEOs here, and to a man and the woman, they say, great, bring it on. It is great for galvanizing more investment into renewables, into digitization, into plans that the EU wants to see as well. Why on earth is it when I speak to Valdis Dombrovskis this morning, yet again, he's like, we don't war, we're having talks, but quite frankly, we see this as potentially as a threat to some European companies. Why don't the Europeans just move quickly on their own version of the IRA rather than worrying about what the Americans do?
Yeah, so first of all, it is positive that the US is now closing that gap on Paris. So that, and we have always asked for that, but okay, there could be unintended consequences also for European businesses. So those have to be addressed. By the way, in Europe we are doing a lot. My country is investing 35 billion euros between now and 2030 on the energy transition and climate change fighting. So we are doing massive stuff. We have to look at state aid rules. That's logical. We also have to look at how can we disburse money from the state to companies, maybe not through the traditional subsidy systems, which can take too long, but maybe making use of the national
Apple's coming up.
Code. Those are the types
yes,
of things
is going up.
Oh, and again, about state aid rules, not throwing them out completely, but looking targeted what is necessary to support also European industries, but from a position of strength. And I sometimes feel in Europe that we are a bit, thinking, oh, the US and what are they doing? No.
Yes.
We are bigger than the US. The internal market of the
Hey, Pum, how you doing? Good morning.
I'm going to still two more questions with you. I know that the director just told me one more, but I'm going to take two because you've just triggered an idea in my head that I've had so many CEOs here saying Europe needs to have a bonfire of red tape.
And I think much is being discussed about the data.
Innovation. I've heard the talk from Mr. Macron. I've heard the talk from European politicians. But CEO after CEO.
So 6 a.m. call-in speech.
Amazing Euro companies, and I'll just name a few.
And I think I saw a tweet about it. The ZQ's coming back up. I need that to stay down.
Europe needs to move quicker on innovation, not just turn it into some great idea, but it into reality that makes it easier for European business to grow in Europe, not elsewhere. Why, Mark? Why are we having the same conversation?
Back to where you were maybe a year ago at some of these firms. So even though the thousands look very dramatic, this is after many years of boom times. So that's why it feels so hard right now. Remember, even at the mass tech layoffs, it really only brings you back to around pandemic levels because of how much the headcount has ballooned. But with tech not hiring as much, with the layoffs in the tech industry, the competition starts to get stiff for where a talent can go next, which is why
all right, 10 minutes.
Say something like that attrition has just slowed down. There's nowhere to go next.
Shanali, thank you. Looking forward to your coverage of this story in the year ahead. Mike and Zach back with us for a final thought. Mike, it's amazing, isn't it? On the one hand, we're talking about jobless claims at 190,000, and then we've got example of example after example across a range of industries saying things are getting bad and the cuts are coming. Which one is it?
Well, I think you're going to see the weakest link break first, and tech effectively is the weakest link.
Hey, Sir Wizzle, if you have time, can you show me a selling strategy for beginners?
And as the economy starts
And
to slow,
to check
more
only once a
as
day.
earnings growth starts to slow, that's
Yeah,
going
I can
to
show you,
impact,
Sir Wizzle.
just like it would any other cyclical.
So the safest thing you can do is you have cash ready to buy 100 shares of any stock. You pick the stock that you like. So let's say you like Apple and you have about $13,000. You have enough to buy 100 shares. So you select Apple. Okay. It's good to check the IVR. Make sure the IVR is not too low. Then it's not the best time to sell premium on it. But if you like the stock, it doesn't matter that much because you want to own it. Then what you do is you go about 45 days out or so. It doesn't have to be if you're willing to own the stock. But the prices are not showing, so I'll show you later. Then you sell a put. You collect money up front. And then you will eventually maybe get to buy the stock at this price, or you keep the premium. So it's one or the other, right? So the reason why it's safe is because worst case scenario, you own the stock and you have the cash ready for it. So it's safer than just buying it. It's safer than just buying the stock right away because you get a better price, right? So that's why it's the safest.
And the Fed has emphasized how much the labor
short put. Short call is risky, so you don't want to sell short calls unless you're more advanced. But short put is safe if you have the cash to buy it and out of the money. I recommend out of the money because then if you get a sign, you'll be happy because you got a good price. But I also recommend far out of the money so that you're extra happy if you get a sign, because that means you get such a good price, right?
And the type of income you can generate from fixed income on top of the fact that there still is a lot of cash out there on the sidelines, we think have been kind of sidelined due to all of the macro uncertainty.
You need to also look at IV. IV is good to look at. IV determines how much you're getting paid for the option relative to previously, right? So this is the IV chart. So historical volatility versus IV. This is important, but not that important. If you're just doing a covered put or whatever, a cash secured put, not a big deal. But it's good to know for if you're getting into more complex positions. It's good to know.
The year of fixed income, I've been told several times. We'll work out which bonds by year end, I guess.
Looks like we're coming up. Apple's coming up.
Find out who was right.
ZQ's trying to bounce here.
0.75%. Fantastic panel to kick off the show this morning. Coming up on the program, the morning calls, and later, Edward Jones shifting its attention to international equities. We'll catch up with Mona Mahajan around the opening.
All right, 7 minutes. So far, so good. I am definitely at an all-time high. I broke my previous all-time high by $1,000 overnight. But that's because the market sold off. So if the markets rebound, I'm definitely going to lose a lot of that. So we'll see what happens here once it opens. But
that has moved markets the most, as I made note of,
we have a bearish bias right now. And a lot of my bearish positions are green. I opened a few strangles. They should mostly be green. Actually, the strangles are not. But these are green. Would you recommend own 100, one symbol, and do covered calls? I don't recommend that one as much, and I'll explain why. Because in my opinion, the advantage of premium selling strategies is you control your entry price, right? And if you give that up and you just go with the current entry price, you put yourself at more risk. You know what I mean? It's like if I show you a chart, let's open up a chart of Apple. and I show you this chart and I go on the daily, and then it's like, where would you prefer buying the stock? Do you prefer buying it here? Do you prefer buying it here? Or do you prefer buying it here? Like, the obvious answer is that you prefer buying it here. So the way I approach premium selling strategies is that I get to be flexible. Like, if I go short, I'll go short here because I'll sell a call here. And if I go long, I'll go long here because I'll sell a put here. So that's why I recommend to do it this way, because you have lower risk. Your entry price is much better. You know what I mean? And you have to be more patient. That's the thing. People like doing covered calls because you get to do it right away. They're like, this is great. I'm going to enter the position right now. But I would only do that if we're already at a major extreme. Like when Apple was here, perfect time. Buy 100 shares and sell a call. Or if Tesla was at 105. But when Apple is here, I would rather just sell one of these and then re-enter here. It's just the way I approach it. But I know that it's popular amongst people to just do a covered call right away. But you can easily get burned. If you sold a covered call last week and you see you sold it around whatever, 136, 137, you're already down quite a bit. But both strategies are safe. I think selling the put first is safer. But the covered call is also safe-ish because you collect the premium. But if you sell off, the premium looks measly compared to how much you sell off, right? And then your entry price doesn't look as good. All right, 3 minutes. Markets want to rally. Apple is up 134. If you already own 100 shares, then yeah, go ahead, sell the calls against it. But if you want to start a new position, I don't know. It's up to you. If you're super bullish and you're confident we're going to rebound, then there's nothing wrong with buying it now, right? It's all about your perspective. Where do you think the markets are going? What's your fair value on this stock, right? My fair value on Apple is definitely not 130, closer to 110. Maybe, even at that. And then you got to watch out because some stocks give you very good premium, which makes it worthwhile selling and being patient. But other stocks don't. Like if you sell an IBM, you're not going to sell far out of the money and you're not going to get a lot of premium, right? So there is always that factor. And the general rule of thumb is you get more premium on what is considered more risky. The IV is generally higher on stocks that are riskier. I have a screener that I use sometimes for IV. So option volume. Here. So I have it sorted by IVR. And these are stocks that should give, not all of them, like ATVI won't, pretty good premium. What's KMB? Kimberly Clark? The fuck? Alright, we're coming up. MES is up. Apple's up. What's the dollar up to? Dollar's down, interestingly enough. Good thing I sold my dollar position. And yeah, we're up to VWAP here on the MES. Apple keeps pumping. It looks like a very pumpy kind of day, eh? We'll see what happens in 1 minute. 1 minute till the market opens. We might just reverse right away. We are reversing. Apple's coming down at least. Or no, wait a second. It's back up. Apple is going crazy here. Apple is going insane. That's crazy volume. MES is going up. Dollar is still trending down. Yeah, I think it's struggling to go higher than this. Take a look at my positions quick. See if there's any outstanding big losers. There isn't. Nice. My daily is very much under control now compared to yesterday. Yesterday I had some pretty big losers. Lulu. Let me look at my other Lulu. Yeah, this looks okay. I am overall up on Lulu. Hold on, let me close this window. Yeah, I am overall up on Lulu. Take a look here. We're coming up, eh? Crazy. High of the day for Apple. So Lulu, I'm currently up $1,000. So if I can close these without too much pain, I will be up on Lulu. It looks like I'm, if I do the balance by summing these up, I'll be at a scratch. But I do have a couple extra here that are going to help make it a winner. Yeah. So we'll see what happens. I can be patient because it is a calendar put. Looks like Apple wants to come back down. Is this like a midday reversal on Apple? Let's try to top tick Apple. So markets are struggling to go above 39.25. Let's open the SPX. And yeah, we have it on the system. SPX looks worse than SPY. Oh, I guess because of after hours, it's true. SPX looks way worse. Maybe we short Apple here, just for a scalp, like a tiny scalp. My account's still looking good, 4082. ZQ is still up, but not as much as before. I need ZQ to sell off. AMR's coming back down. It's funny, I was so happy about this trade yesterday. Apple is pumping here. Do I fight the trend? High of the day, okay. Looks like I top ticked it. See if we get our face ripped off here. Honestly, I'll take $5. So I took a small hit, $200 hit on my P&L, but not too bad. I'm still way above my previous all-time high. So, looking good. I gotta let premium do its thing, theta decay do its thing. And then we gotta hope that the SPX sells off. I can consider taking profit on this bear put that expires in tomorrow. Might be a bit risky to hold this, but I kind of need it to counteract the SPY 370 puts, right? It helps to counteract that. How's my coin short? Okay, that one bounced a little bit. I have a lot of shorts. So I can show you, for example, if you go to the Apple option chain, let's say you have $12,000. You can go to Feb 17th. You don't have to go too far out, but sometimes it's better. And you can sell the 120 puts because you have $12,000. And then you're going to pick up $100 up front for selling that. And then worst case scenario, you own Apple at 120. You're a bag holder at 120. That's like worst case scenario if it like continuously dumps. But best case scenario is actually you pick it up at 120 and then it bounces back to 130, right? So that's like the best, or bounces back to 150. The idea is that your worst outcome is you own the stock at the price you chose. So that's the main idea behind selling a put to enter a position. And I think it's very powerful. You get to choose your entry price. You just got to be patient. You're not going to get rich in 2 days by doing that. Lows now. Yeah, I noticed. And Apple is selling off. New low of the day. It's looking good. ZQ isn't playing along, but that's fine. If ZQ keeps going back up, I might sell a second contract. I considered doing it last night, but I was like, nah, I'm going to play it safe. What a tight range, eh? Look at that. The first 6 minutes. This is the high, this is the low. Crazy tight range. I'm not even on the system. Let me load the system. The famous system. The 30-minute chart flipped yesterday. Yeah, look at that. I wasn't paying attention to that flip. I need to make those lines thicker so that it's easier to see. Yeah, it's looking bearish. The 5 minutes looking bearish. We're actually approaching a negative retracement line. I'm gonna have to draw new Fibonacci's now because we have dumped below the 0%. This was our CPI lows. So yeah, we dumped below that. I don't know why Apple is so resilient and why is my P&L down a bit. That doesn't matter though. That is fine. As long as we get the price action we want. Let me look at my my other side here. Okay, this one's fine. Microsoft 234 isn't too bad. Lulu 316. SPY 370 puts. What are some other unexpected loser? Nvidia 140 puts. Might not need this position because Nvidia could sell off fast. Maybe I can sell a few shares of Nvidia, short it. Amazon 75 puts. It's fine. I think it's fine. It balances out so that I'm not too bearish. It's good to have some positions to flip in case. FXI is not working out. I was hoping for China sell-off, but it didn't happen. Short strangles are mostly flat. Mostly flat. Apple short, it looks like we bounced. My Apple short is losing. And Coinbase short is doing better than my Apple short. SPY. But I do have Coinbase short puts, right? So, yeah. But the IV was high when I sold those. There we go, we're bouncing, yeah. Maybe one thing I can do to counteract all my bearishness is just get like a $50 call spread. That's a $100 call spread. Way too expensive. What if I get like a single $50 call? Or two of these $60 in case we get like a violent bounce off of this low. The odds are so low that it's like wasted money, but it's only 15 bucks. Yeah, I'm taking a hit here, 4079. This one is 200 bucks. We're gonna be patient here. Just see what happens. Don't be too quick. Apple is pumping. ZQ is back up a little bit. I don't know why this chart doesn't fucking update properly. Five-second chart? What is that? Okay. So, okay, back to 408. That's okay. I think just slowly trending down is the best case scenario for me. So I'm happy with this. And I don't mind a little bit of chop. But I want to see a downward trend. I want to see like red candles daily. Alright, such a tight range, eh? Look at that. We have a $10 range from the past 12 minutes of trading on the SPX. Low vol. Yeah, Apple's looking strong. But I always pick the wrong ones when I'm wanting to short with the market. Sometimes I feel like it's easier to just short the actual market. I always pick the ones that are strong. Yeah, Netflix is still strong, 322. But earnings is today. I might open a bearish position on Netflix for earnings. We'll see. It's going to be a bit of a gamble. Maybe it hits. It's trending down pre-earnings. Okay, it looks like the markets want to come down. Dollar's going up. Okay, US dollars coming up, Apple's coming down. We're near the lows of the day on the SPX. My positions are looking good. I do have a few with daily losses, but they are balanced out. This Microsoft one is looking pretty risky here now. But I need like a few positions that are super bullish in case we go the other way. Then these will go green. And that's a $1,400 of value. So it's good to have maybe not quite as many. That's 6 contracts. That's a little bit too bullish, but that's how I try to keep a balance, because otherwise we're going to rally and I'm not going to get anything out of it. But if we keep selling off, it reduces my potential gains. ZQ is not going the direction I wanted it to, but it's fine. Markets are selling off here. 39.05. New low. 39.04. It's coming down. I gotta see whether I should change my position a little bit. Maybe remove some of my bullish plays. Trim them down. But I'm going to be taking losses into weakness here. Yeah, Lulu is definitely not working out the best here because of I should have sold the 310 puts so early. That was a huge mistake. I mean, I do have some of these that are benefiting, but not by much. I mean, I think Lulu's gonna be a scratch when the smoke settles. But at least these two cover each other, so I think it's fine to hold it like this. Yeah, I'll figure it out. It's gonna be complicated if we end up going in the money here. But it gives me a lot of positive theta though. There's a lot of extrinsic value to this. So yeah, it should be fine. Should be fine. Apple's coming down. I'm back to 408.2, that's good. I feel like I'm taking too much of a hit on my bearish positions, but part of it is because we're going down a little bit too fast, but it's fine. This is calculated risks. My MicroStrategy put side is losing now, but hopefully my call side is winning. Yeah, my call side's winning. Not by much. Actually, no, wait a second. That's the wrong position. Yeah. I have so many positions. Oh, that's Microsoft. Sorry, too many positions. I gotta do this sometimes. Yeah, this one is still a loser. Damn it. Both losers now. I need time decay. It's fine though. I'm $1,000 over my previous all-time high. So I definitely cannot complain too much. My short Apple is probably a good position. I may have top ticked Apple. Like if we keep selling off, I gotta sell I got my sell order in here. That looks a little bit like a top. Maybe that's gonna be a short-term top and we sell off back to 125. We're at new low of the day on the SPX. I might keep this Apple short just to counteract the SPY shorts. SPY shorts are looking a little bit risky here. But overall, I can't complain. My account's doing well with this move. This Iron Condor is going to benefit greatly if we keep selling off. This one has about $300 of additional gain if we keep selling off and we hold. This expires tomorrow though, so I may want to take profit. There is a bit of duration risk here, time decay. But they benefit from time decay too, so overall, I'm at 570 theta, so I could pick up some more theta. But the problem with picking up theta here is selling upside is risky because we might just bounce back. And selling downside is a bit too early. I'd rather start selling downside once we hit 3,800. Because I already have quite a bit of downside risk. Maybe sell more upside. Just go extra bearish here. Tesla's resilient, 128. Lulu's a big loser today. But we'll see. Maybe Lulu will rebound by the end of next week back to 310. And then I'll be able to take this off at no loss and then keep selling puts against this. Because if we expire in the money, I'll have to close it all. And then see how much I win or lose on my Lulu trades. At least I have this one here, but that's 43 days out. I might close this and then sell a closer call. Yeah, closer in date, closer in strike. Just to benefit more. So yeah, we're gonna roll this. See if we can get a good close. Okay, we got a good close. And Apple's bouncing. But it might be too early. I might just make we might just rebound right away. Then it would be risky to sell the call now. Lulu's at the low of the day. So let's go 8 days out on Lulu. And maybe sell the 330, 327.5. That's where it was after earnings. That was like a resistance level after earnings. But what if Lulu bounces again? Then I'll be in another difficult position. That's a bit risky. Close to at the money. We get a bounce, it loses value fast. Maybe not quite as aggressive. Maybe like a ratio here. Ratio seems safer here. But then it's only 87 bucks. But it has a pretty good max gain though. Well, not that great, but... Does it keep selling off? It's at 311. Maybe the play I did was correct to keep it safe. But I feel like that's a bit too late of an expiry. Let's go Feb 3rd and go 340 call. That looks safer. Less delta risk to the upside here. $337.5, 2 weeks out. All right. So that helps with Lulu. Okay, it looks good. All right. Dollar is back up, and dollar was pretty low this morning. Lulu keeps going down. Crazy bearish. These 1 minute candles are super bearish on Lulu. It's fine though, my positions are balanced, I think. A little bit too balanced with some of them. We're at 3900. This could be a bouncing point, actually. This could be one of those inflection points where we bounce. How's my Apple short? Ah, it bounced back up. Damn it. I was so happy when we were here. Why is Apple so strong today? This is unbelievable. With the SPX so low? How's the NQ? Is that why? Apple is bouncing here. Wonder if we do open more downside risk. GME's down 7%. That might be a target for downside risk. GME's had a pretty bad few days in a row. Baba's up. Some of my strangles are losing, like this IBM one is losing. Fluoro 8.1. All right, 7 o'clock. Let me check the economics calendar. What do we have coming up? Amazon and Microsoft are resisting. They are, aren't they? Amazon 94. Microsoft is down though, 232. Good thing I reduced some of my risks in Microsoft. I still have quite a bit of downside risk, but I think I also have upside risk that should be benefiting from the sell-off. Yeah, a little bit. Should maybe have had more upside risk on Microsoft. It's a tiny position. No, I have another one. Yeah, I got 2 upside risk positions. They're benefiting very little though. But I don't like selling naked calls. When it comes to calls, I feel more comfortable with a spread. SPX is bouncing off of 3900. Is this going to be another bull trap? We do have a bit of a trend line forming here, so... Yeah, it looks like we broke this earlier in the morning trend line. Kind of. Oh, we bounced at this negative Fibonacci. Crazy. Exactly on that negative Fibonacci. But that's exactly 3900 too. So you took profit? Nice, man. Good job. I can consider taking profit off mine, but no. These are my positions that I need to counteract all this bullish position. So I can't take profit. I'm going to expose myself to too much risk. Maybe this one here. This one expires tomorrow. You're thinking on re-entering? Oh, yeah? You might get a better entry point if we bounce. There is a chance we bounce, but we might not. We might keep selling off, right? Yeah, Apple looks really, really strong today. I always pick the wrong stocks to short. I could have taken my profit here. But I got euphoric. I was like, yeah, I got the top tick and we're going to go back to 120. Alright, looks like we're coming down here. 7 a.m. on the dot. We got a bit of a red candle. All right, I'm going to take this opportunity to go and make myself a tea and a bagel. I'm going to wait till there's a news segment to play, and then I'll go make myself a snack. There, I think. Yeah.
Investors firm up Fed rate cuts and increase pessimism on stock. And P&G,
All right, I'm going to be right back.
Sales volume falls for the consumer staple giant even as the company managed margins and grew organic sales. Stock, though, down 1%. Inflation has peaked. The words from Morgan Stanley CEO James Dimon telling Bloomberg that prices are clearly going down. The question really is how quickly the Fed can get to 2%. We're going to speak with Brian Moynihan, Bank of America CEO, and get his outlook on the economy. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I'm really struggling to take a macro signal from the price action we've seen in the last 48 hours. And to point out, the S&P is now below its 50-day, and I just wonder how much the technical story is also playing into the action.
I think you put your finger right on it, Alex. This is a positioning story. It is not about the data. Yesterday, we saw equity markets selling off because we thought that the data was signaling a recession. Today, take a look at the claims data. U.S. labor market is looking really solid right now, but that's bad news as well. So bad news is bad news, and good news is bad news. To be honest, this is our question of the day. But as you say, this is about positioning. This is a market that's come a long way very quickly. European equities, for instance, 6 days up, 1 day down. It's been quite a run.
Yeah, did you just agree with me off the top of the show? What is happening? This is an alternative world. I don't understand. So to your point, though, did the market suck people in over the last 24 hours with the rally? And if so, I mean, with last week, and it sucked everybody in, and then now you have to reposition, and that going to add more momentum to the downside? I don't know, and I don't know how then you trade the market.
I don't know, but maybe me agreeing with you is also some sort of weird price signal as well. Maybe, yeah, precisely. Who knows? All of this stuff is really difficult to deal with right now. But I think you have to come back to how is the market positioned. I think if you start there, maybe some of this does make sense. And you're also getting a different reaction, obviously, and a different take on all of this in the equity market versus the bond market. And that's a narrative that you need to kind of digest as well. I don't know. There's a lot to kind of work our way through here. But let's start the process. So here's the question. We're going to try and figure it out. Stick with me here. Is bad news, and is good news bad news as well? Let's try and get some sensible answers to what is fundamentally a silly question. Jess Menton and Ira Jersey joining us now to give us a take. Jess, let me start with you. What is your take on this? Bad news, good news, bad news. Your thoughts?
Well, we could blame it on a lot of the data we've gotten over the past 2 days, whether it's looking at those producer prices data, which did show some signs of glimmers of hope, but then obviously looking at the retail sales data coming in not quite as strong as expected for December, which is clearly a key month when it comes to the holiday spending for the consumer. And then looking at today, those initial jobless claims still coming in weaker than expected, which shows that labor market strength. But I would point to some glimmers of hope looking at the CPI versus PPI spread. It actually turned positive for the first time in 2 years. And so I reran the data with Bloomberg Intelligence. I was talking to Jillian Wolfe over there, and she's an analyst at Bloomberg Intelligence. She was talking about how this is actually signs that what the Federal Reserve is doing is actually working. It doesn't necessarily mean that we'll see them dramatically pull back and aggressively stop just after raising rates after this next meeting. But that's the first time in 2 years that you've seen that spread turn positive. And the reason it's important is because that bodes well when it comes to corporate margins. And we've been talking about the margin story for quarters now as far as when are we going to see the pain subside there, which obviously has a strong correlation with what it means for stock prices. And Gina Martin Adams at Bloomberg Intelligence has talked a lot about this. So since that correlation and that spread is actually positive now, that could actually bode well in coming months or even by the time we get to the middle of the year for stock prices.
Which, Ira, it raises the question, too. We just look at the beige book, for example. That echoes something similar. Prices coming down, growth maybe a little bit murkier, but like nothing terrible. What do you think? Is everything just going to be taken as bad news, though?
Well, it depends on what you consider bad news. I mean, I think from a public policy perspective and talking about monetary policy, then seeing some of this slowdown in retail sales and slowing in inflation numbers is obviously a good thing for the Fed. And I think that it will, drive at this point policymakers to slow down to 25 basis points a meeting, and then maybe not go too many more meetings, right? So I think we're at a point where the Fed is in calibration mode, and so when you get bad news, right? So when you get things like retail sales going down, that might actually be good for risk assets and good for the bond market as well, because the next move after the Fed stops hiking is going to be cuts. Now the question is, when will that happen, and how deep the recession has to be in order for us to get there.
Ira, let me ask you a slightly different question. The claims data, and maybe there's some wrinkles in the numbers here. This is a tricky time of year to figure all this stuff out. But the claims data is pointing to an incredibly strong labor market in the United States. The Fed has pointed firmly at the labor market and says we're going to have to cause some pain there. Yet at the same time, the bond market is signaling that we are going to see a significant recession. Everybody I'm talking to at the moment says the labor market's strong, we're not going to get a recession. Therefore, by extension, can I assume that the bond market is wrong?
I don't think you can. If the bond market's wrong, I think it's wrong in thinking that there will be cuts this year. Because, Guy, you make a good point where if the employment situation remains pretty robust, even if the overall economy is weakening some, that gives the Federal Reserve some room and wiggle room not to cut interest rates this year. So I think that the market's not wrong in that at some point the Fed will lower interest rates, right? So 10-year yields being at 3.5%, it's fine. I mean, you're talking about the Federal Reserve cutting interest rates, 150 or 200 basis points sometime in 2024 or 2025, right? So further out. Now, the front end of the curve, though, could be mispricing a little bit, and I think, quite frankly, has been mispriced. But what the bond market's pricing, we have to remember, if we're priced for 25 basis points of cuts by the end of the year, that's probably 0 or 50 basis points of cuts, right? So there's a little bit of a bimodal distribution going on here, I think, that we kind of miss with these averages that we get with what the market's pricing.
Okay, so calculating all of that, Jess, can I just chalk up the last 2 days as, hey, we had a really great rally for the first couple of weeks, we're just going to take some profits?
Well, the biggest thing that we've been focusing on is taking a look at what's been happening with short covering. So Goldman Sachs' basket of the most shorted stocks, it actually had been outperforming the S&P 500 pretty substantially for the first 10 trading days of the year heading into this week. So when you see that kind of movement, and it continued over the past few days, so that really signals that there was skepticism that was happening there. And Chris Harvey over at Wells Fargo, he actually put out a note this morning, and he was talking about exactly that data and what he was seeing there. So he thought the recent rally was a little bit overdone, and when you're seeing movement like that with short covering, that really shows how there's a bit of skepticism, especially when we're coming off the back of a year with nearly a 20-cent decline in the S&P 500. But a more positive note, it's very rare to see 2 consecutive years of back-to-back declines in the S&P 500. It only happened in the recession in 1973 and 74, and then obviously in the early 2000s with the dot-com bubble burst. So a lot of bulls are actually hoping that potentially we won't necessarily see that happen again, and potentially we will begin to see margins ease up, and that could bode well for stock prices heading into the first half of this year.
There are a few bumps potentially along the way. And one of them starting to come into view in a little bit more detail. Within the last couple of minutes, the US Treasury has begun using extraordinary measures. Janet Yellen, the Treasury Secretary, saying the Treasury will begin using its debt limit special measures as of today. Ira, what's priced around this? If this gets ugly, how ugly could it get?
Well, I mean, the worst case scenario is that we actually do see a default on the debt for some period of time, and nobody really knows exactly what would happen after that. So, how much, with the full faith and credit of the United States government in doubt, that could create significant volatility in risk asset markets, and we have no idea what will happen in the Treasury market, and if people would just run away from Treasuries, causing yields to spike significantly. You are seeing some movement movement in some of the Treasury bills that might be at risk of missing a payment or having a delayed payment. But there's still a lot of moving parts, and it's really difficult to judge. Our model shows that it's really not a problem until the third quarter, that the Treasury Department has enough of those extraordinary measures and will get enough cash to reach into September. But that being said, there's a lot of moving parts, and if tax refunds come in a little bit higher than we expect, that can shift those calculus quite a lot.
No, it's such a good point, Ira. But we'll definitely be talking about this past July for sure. Jess, Ira, really appreciate it. Jess mentioned a Bloomberg and Ira Jersey of Bloomberg Intelligence. Thank you both very much. All right, coming up, we're going to get more on that question of the day. Is bad news bad news? Is good news bad news? With Joanne Feeney, portfolio manager at Advisors Capital Management. And as we head to break, we spoke to the governor.
Wages will increase. But it's, again, here we're talking about a possible hard landing based on yesterday's numbers, and yet today's numbers on the labor force certainly suggest that the jobs are there.
We'll see. A lot of contradictory cross currents, at least for the moment, Ed.
Right.
Appreciate it, as always. Good to see you. Ed,
My pleasure.
As we head to break, here's our roadmap for the rest of the hour. We've got more on today's market action with UBS's Art Cashin.
Plus, the latest from Washington as what we were just talking about, the debt ceiling deadline looms. Treasury Secretary Janet Yellen pens a new letter to Congress about that just this morning.
And finally, Discover Financial shares slumping after results there last night. We're going to break down the numbers, take a look at the net charge-offs and what it means for the health of the consumer with their
All right, looks like we're selling off again. Good timing for me to come back. I fried myself an egg in butter, and I'm having it with bagel and tea. It's a pretty good mix. All right, we keep bouncing off of this 3900 level. It's crazy. It's like they don't want us to go through it.
resolutions until we get down to that deadline. And I think that's why investors are so worried, because this is all going to come down to the wire.
Elon Moy, thank you. Discover dipping despite a beat on the top and bottom lines, seeing a 20% increase in overall loan growth year over year, but a hike to provisions for credit losses and a projection that net charge-off rates will double this year, signaling that customers are falling behind. Well, here in a CNBC exclusive is Discover CEO Roger Hochschild. Roger, great to have you on the show. And we just sort of teed it up right there, but the fact that your earnings did beat, it's really that net charge-off guidance. It's that view on debt that will be owed to the company and not collected that's really putting the stock under pressure today. Walk me through that doubling and what is assumed in that guidance.
Sure. So first, I'd say 2022 was a great year, second most profitable year. And so I think our strong Q4 is getting a little lost. But, losses had to come up from the levels they were at during the pandemic and immediately afterwards. So what you're really seeing is normalization for our prime portfolio, as well as just some of the more recent vintages starting to hit their peak loss rates. So we feel really good about what we're seeing from a credit perspective, and I couldn't be more excited about the year ahead.
Okay. Is the possibility of recession baked into all of that guidance?
Definitely. Clearly a lot of uncertainty around what the economy will hold. But, so far, the prime consumer is doing really well. We're seeing sales for January so far up 13% year over year. And I think what's helping our customer base is the really robust employment market. Even a lot of people getting laid off are finding jobs relatively quickly. And so I think that's very constructive as I look at our portfolio.
Yeah, and we did talk about, you did mention the fact that you saw loan growth. How much of that is the impact of inflation? And I guess how is that inflation affecting how consumers are banking with you and how consumers are using their credit cards?
So inflation and the rate environment are really helping us in a couple ways. First, our deposit business. We're seeing very strong flows there, and I'd contrast that with the outflows that some of the traditional branch banks are seeing. Second, we're seeing a lot of demand for our personal loans, for debt consolidation and home equity loans as consumers react.
All right, looks like we bounced off of that line once again. Crazy.
And then again, on the credit card side, really strong usage, but disciplined payments. Payment rates on credit cards still remain about 300 basis points higher than they were prior to the pandemic.
Net interest margin, what you're collecting versus what's going to push back out to customers this year, is that something that could pressure margins?
No, we in fact expect to see net interest margin more modestly higher in 2023. So that combined with the strong loan growth give us a lot of momentum on the revenue side.
You mentioned normalization. You also said you feel really good about what you're seeing in terms of your credit portfolio. So give us a sense. What does a normal world look like? Is this it? Can we not expect to have a significant increase then in terms of provision for credit losses next quarter?
No, we do expect losses to go up over the course of this year. Depending on the economic environment, hopefully the rate of increase will start to tail down towards the end of the year and then peak early in 2024. But again, a lot of that depends on what we see in the economy.
Roger, what are your assumptions on unemployment? Do you see us getting up to 5% plus? And does that have big implications for
my first solar positions are looking good. That's $200 right there.
Unemployment traditionally is the largest.
Good entry point. I'm going to consider closing this one that is time sensitive, maybe. By end of day. It expires tomorrow.
Certainly we're making adjustments continuously in underwriting.
Can't even close this.
In the back half of last year, and we'll continue to adjust. And again, this is a business we've run through multiple credit cycles, so we've got established.
IBM is a big loser, surprisingly. What the heck?
Finally, just want to ask you about your digital banking and payments business. Plans to expand in that segment, and how does it speak to the competitive landscape more broadly as we see tech become a bigger and bigger part of the financial picture overall?
So I think Discover truly is going to be the digital consumer bank of the future. We've got some significant advantages in terms of having our own payment network. And so we're going to be relaunching our cashback debit product this year. A real differentiated product, builds on our heritage of rewards, but brings that to people who want rewards in the debit space. So I think that the transition of Discover from being known as a credit card company to a digital bank is well underway. And I couldn't be more excited about what lies ahead.
Okay, Roger, thanks for joining us today on the heels of Discover's earnings. We appreciate it. Roger Hochschild.
I'll take a look at some of the underperformers on the NASDAQ this morning. Some high multiple names in there, along with some semis actually getting hit, Qualcomm among them, as the Dow is off the session lows that started this morning, down 170. Stay with us.
I'm thinking about selling some premium in high yield because I feel like high yield is going to be bearish. I don't see why anyone's going to put their money in high yield right now. So, but it seems like there's a lot of put skew here in high yield. A lot more value for puts than for calls here.
Is going to getting from point A to point B, we don't know yet. We're going to target basically the debt and increasing of the debt to how we can basically prevent that from continuing to increase as it does and start a downward trend. And there has to be some discipline and there has to be some sacrifice.
And you can watch the entire interview with Senator Joe Manchin.
Maybe I can do a risk reversal trade here for high yield. Perhaps that would be a good idea. Like sell the 77.5 and buy the 72.5. But I don't know. It doesn't seem like the credit makes it worth it just overall. We have some analyst changes. Let's check it out. Oh, I missed it. Where was it? It's quite a few of them. So CRM is a hold. CrowdStrike outperform. Disney outperform. IBM is a hold. Microsoft sell. That's two sell. Oh no, actually that's one. That was yesterday. I think that was yesterday. Shopify is a hold. Okay. See what's going on. EWZ's down. FXI's up. Silvergate. Go back to the SPX. 3902, we're coming back down. We're gonna retest this again.
Secured tweet, of course, where he told the world.
Made an appeal, right? I'm hiring right now, so if you've lost your job, reach out across a broad range of hardware and software applications. What we keep hearing as well from venture capitalists time and time again is that just as we saw in the aftermath of the dot-com bubble and the 2008 financial crisis, when layoffs like this happen, for one reason or another, companies are letting go of talent, really talented, often software engineers. Those people go on to found their own companies. And if you look at some of the names that came out of recession and some of the names that had success, some of them are now some of the biggest mega cap tech companies. So that's also a theme as well.
Ed, I know it's a stretch, but would Netflix be included in that? Could they benefit here?
Yeah, Netflix, I mean, they, let's be honest, we're all focusing on subscriber growth once again. Consensus for 4.5 million net new additions in the most recent quarter. and of course the success of their ad tier. But actually, if you look at the bullishness on the street right now, loads raising their price targets, is because the content slate is improving. A big story for 2023 on Netflix as well is their in-house developed video games. These are largely mobile games, not sexy console ones, but they've invested heavily, and you need talent to do that.
Nobody cares about Netflix video games. I think that's the silliest thing. And I would actually short Netflix if they overinvest in their stupid mobile games. Nobody cares about that.
Things, but kind of moves fast and breaks things in this effort for transparency versus someone who is reckless and costing people, investors, a lot of money. And it's like that's like every day talking about Elon Musk, but this time it's in court in front of a jury.
They kind of go together, though, in some way. He does do all those things. He moves incredibly fast. He accomplishes enormous amounts that don't even seem possible. Including what's going on at Twitter right now, as he sleeps on the 8th floor of that company's office building and is continuing to obviously try to remake Twitter. But at the same time, he does things that many people say, why did he tweet that?
Yeah, and we should also note, Tesla stock, it's up more than 450%, I think almost 480%, splits included and everything, since that tweet. So maybe that was a rough couple of weeks and even a rough couple of months, but it's been, despite even the sell-off last year, a very good couple of years for Tesla stock.
Yes, many shareholders are quite happy that the board did not in any way, or they were unable to even consider really the go private at that level. Because if you'd sold at 420, you would have missed a lot of upside.
Piper today, by the way, says the price cuts that we talked about at Tesla earlier in the week might actually be helpful. We think Tesla can easily achieve 50% delivery growth in 2023 in the U.S. alone. So that's been adding to the positive chatter about Tesla last couple weeks.
Okay. Well, it's been a volatile week for the markets more broadly. As investors weigh cooling inflation against a hawkish Fed, we're going to break it all down, where things could go from here with UBS's Art Cashin.
You got some calls? Oh yeah? You never know though, they might print. All right, it looks like we keep bouncing off of that Fibonacci 3900 level, and we are hovering above this line. It looks like market wants to dip, but we might just be range bound here all day. I think as long as we stay below this line, it's really bearish, because that means we're below CPI. And yeah, I do think today's job report was bearish because it shows too much of a strong employment labor force, This means rates have to stay up. I don't think the Fed is gonna cut until there's like severe unemployment. And then even then, it's still bearish at first.
It was genius.
Discuss. Yeah, okay. Kaylee, thank you very much indeed. Kaylee Lyons. European equities are basically erased Monday, Tuesday and Wednesday's gains today, just in terms of context of what we're seeing here. Let's take you back to the World Economic Forum. The annual meeting continues in Davos. Morgan Stanley's CEO James Gorman telling Bloomberg TV earlier that the global financial situation is not as bleak as it seems in part, thanks to China's reopening.
There's clear evidence inflation has in fact peaked and is coming down, right? How quickly, whether the Fed will get us to 2% and when, remains the debate. But is clearly the slope of the line is positive, is to everybody's favor. And the second is not just the opening up of China, but China has embraced the rest of the world more aggressively in the last few weeks, witnessed by the Vice Premier meeting with Treasury Secretary Yellen this morning, I think it was this morning, in a way that we haven't seen for some time. So the big question coming out of the Party Congress and President Xi, being re-elected by the Congress, was where does China go from here? Does common prosperity mean effectively dividing the pie up so everybody gets a piece of it, or by growing the pie? And what we're seeing is the tilt is now from divide the pie to grow the pie.
Does that mean you've got more confidence to expand in China?
We've got a very good business in Greater China. Obviously, we have a huge business in Hong Kong, and we continue to have, I think, on the mainland up to 1,000 people in various functions. But no, I think we need to see a little more clarity of Chinese policy, a little more sober discussion around global trade relations, and right now I think we're certainly in a watch, but tilting more positive than we would have been 3-6 months ago.
Morgan Stanley CEO James Gorman, a little caution there on what's happening in China, particularly around the geopolitics. Speaking, of course, of the World Economic Forum. Meanwhile, optimism is not necessarily bleeding through into the housing sector. Kaylee was just talking about this. US home construction declining for a fourth straight month in December, wrapping up what was, to be honest, a pretty disappointing year for the industry. Patrick Carroll, CEO and founder of the real estate firm Carroll, joining us now to discuss. Patrick, what is your sense of this housing market? We talk about it as if it's one market, but it clearly isn't. Give me the nuanced picture of what you're actually seeing.
Yeah, so thank you for having me. We focus on multifamily for rent, throughout the Sun Belt. So, the effects that you're seeing in the single family market is, in one hand, it's good. It costs roughly double to get a mortgage now than it did about 8 months ago. So that, it's keeping people renting longer. And that's why you're seeing builders pull back from building single family homes. There's not as much demand because they can't get mortgages, and so that's really affecting it. On my side of the business, multifamily, you're seeing a lot of effects. Even though we have high occupancy, our cost of to finance has gone way up, insurance is way up. So while we're still pushing rents, we're also seeing our expenses creep up too. So it's.
So can you push rents higher? I mean, because the idea is that the Fed's waiting for the rental market, in essence, to roll over, and that's going to really wind up helping inflation. Is that actually going to happen? Like, can you afford for that to happen?
I hope so.
Okay.
In theory, the reason I think
I can open a super aggressive ratio spread here, 3 to 4 ratio. These are hard to fill though. I'm not going to get mid-price. On SMH. Let's see if I can fill it near mid-price, because if I can, this will be a good omnidirectional trade with a decent max profit, $1,000 bucks.
Let's just dig into that a little bit more if we can, Patrick. Are you able to do that?
See if I can fill it at mid.
Continue to do that, maybe not quite at the same pace.
Or near
as
mid.
long as the employment market holds up. Is basically everything centered around what is happening with unemployment, employment. Companies seem to be holding on to people right now. They're looking for people. They're still struggling to find the people.
No, I might just do a 1-2 ratio
Do you think the rental market will be well supported?
and see how that works.
In one hand, the single-family market slowing down and interest rates going up and people not being able to buy is good for the rental business. On the other hand, if people are getting laid off and they can't pay their rents, that's not good for anybody. So yeah, it's a tricky thing to figure out.
A little bit further out and 1 to 2. That's probably good. Oops, sorry.
Positive immigration, a lot of positive job growth. People, like you said, are still hiring. So
Yeah, this is good. If I can fill that at mid,
I'm bullish that
or 1 point off of mid, that'd be great.
But yeah, the economy at large, that's a
2 points.
It's a very scary thing.
So if you did 20
Come on. Okay, I'll be right back. Okay, we got it. Apple is pumping.
I think we see, something more normal, around 5 to 10%. But historically in our markets, you really only saw 3.5 to 6%. So, last year was an anomaly. You had COVID turn the world's eyes on the Sun Belt. People moved out of
These hourly charts are looking so bearish. Okay, we're gonna start a new Fibonacci line because we're out of that trading zone, that trading range, and I see a new one that we can draw. So this is using last week's lows and this week's highs.
Florida, Texas, different markets.
There. So we have a new Fibonacci retracement line, and yeah, we're at the 50%, we're below the 50% retracement, and we're approaching the 38.2. So that means we're closer to last week's lows than we are to this week's highs. Seems like it, although the math doesn't add up. Looks like we're pretty close, yeah, it makes sense. 38 versus 40.10, yeah, it makes sense.
You have a bid-ask spread. Sellers are not willing to take what buyers are willing to pay, and so it's kind of put the market on, freeze. That said,
all right, we're back to VWAP on Apple.
Positive fundamentals in our market.
I could have taken profit, like 20 bucks on this short day trade.
Texas has been a great state, and I think it'll continue to outperform just like, the rest of the Sun Belt.
Patrick, we really appreciate it. Thank you for your time today.
It's funny, it's only 7:30, but it feels like half the day's gone. Because I woke up at 4:30 in the morning.
Thoughts on how that flows into the market conversation, how that flows into the global economic conversation.
Alright, Lulu got a bit of a bounce here, that's good. I need Lulu to stay around 310, then I can extract all of the premium from here and keep this long put alive. And then I gotta maybe start looking at new positions, but I'm hoping we sell off first. I did open the SMH, so that's good. I took some profit off of the other SMH, not much. Let's look at my screener here. What is SMCI? Super Microcomputer? What is this company? Never heard of this shit. Oh, it had a huge red candle. And look at that. That was yesterday or today? That was today. Something horrible must have happened. IVR's at 95 too. And earnings are coming up. Too risky.
If you think we've reached some level of fatigue or the notion that we might be in for a long-term stalemate, does it feel like the market's reacting to Putin or NATO headlines the way they did, say, in the middle of...
There's only monthlies.
I think the market's trying to assess something about that, Carl. Right now, the Russians still have air superiority, and they're pushing on it. They're, in the meantime, doing joint...
I don't know how risky this is. I don't know nothing about this company. But it's having a rough time today. These ratios aren't paying much though. 50 cents for this ratio. That's not much.
To send some of their troops up north to protect against it. The Ukrainians have the advantage on the ground. The Russians do not look
Paramount.
like they can counterattack on the ground. The real problem for the Ukrainians is, as you point out, even though it's been good weather in Europe, the Europeans seem to be...
Blackstone is always in this list. Blackstone has earnings next week. I think Blackstone is losing money this quarter. Meta's up. That's surprising. Maybe I can sell some upside on Meta. Since Meta's up. Let me check my Meta positions. I closed all my Meta positions. So maybe we sell upside on Meta since it's up today with the down market. Maybe some kind of strangle on Meta. Like I can go pretty far out. I can go up to 170. Actually, call side, I'll go closer. Call side, I go like 155 or 150. So 32 delta. And then put side, I'll go like 17 delta. So that it's a bearish play. And so I have more risk to the upside, although that's a little bit too much risk to the upside. We're pretty close to 150, maybe 155. I can just do a ratio spread for this one. I get pretty good ratios here. Like a 1 to 2 here seems pretty good. That is $1.98 for this. That's a pretty good ratio to add in a bearish play into the mix. Not that I don't have enough bearish plays, but why not add another one to the mix here for an extra 188. Let's see if we can get a good fill. Yeah, that's a good fill. That's an easy fill. Wow, the ratios are tight there. Very tight. All right, go back to SPX. See what it looks like on the 1 minute chart. Yeah, we are staying below 3,900. Looks like we lost that support. That's become resistance now, maybe. Apple's trending down. I do have my short shares. I do have short Coinbase shares too, which isn't doing much, but that's okay because I have a lot of short premium on the put side there. I got to get my green numbers up. My green numbers are a little bit struggling compared to the red numbers. But most of these positions are very newly opened. I wish I had a column that said days since open. You know what I mean? So that I know exactly how many days I've had them open. I had a spreadsheet that kept track of that, but it was way too much work to manually add positions. So far, so good. I'm really happy with my month performance so far. Being up 1% in 3 weeks is decent. Although it doesn't hit my target, but I do have another week. 4K in a week will be a lot. Will be almost impossible. But I'll be happy with 1.5%. If I can get another 2,000 in a week, then that's going to be 1.5%. And I'll be happy with that. It's definitely possible. You just got to be careful and avoid bad positions, avoid traps, and take advantage of theta where I can. This position might eventually be profitable. It's such a wasted position I opened. There's like very little risk to have this on. It just takes so much buying power. It's negative 0.002 delta. Crazy. Awesome. Yeah, man. It's been good. It's been good. If I can keep this up every month, then I'll just grow my account over time. But the biggest problem for me is my expenses. Like I got to take 3,000 out a month minimum to pay my expenses. So that's the annoying part. CNBC Business News. Looks like we bounced off of 38.92.
Names in the action in the financial sector so far, which you can see here overall is one of the underperformers. Now, Northern Trust is the S&P's biggest loser right now after reporting earnings that came in more than $1 per share below analyst estimates. Now, elsewhere, B of A Securities has double downgraded Charles Schwab, the discount brokerage giant, saying the firm's growth would decline as clients adjust to higher interest rates, and also watch insurers like Allstate lower after warning that catastrophe-related losses would be higher due to the recent winter storms that we saw back in December. So insurers have been riding high, relatively speaking, now taking a bit of a hit now. Now I'll send things, Carl, back over to you folks at the New York Stock Exchange.
All right, Don, thanks so much. Coming up this morning on Tech Check, just a couple minutes away from Netflix tonight, of course. This afternoon, we got more on the key metrics you should be watching here in a moment. Don't go away.
After we did the LaSalle transaction, we peaked at 6,000 branches. We peaked at 100,000 people working in consumer business. Fast forward today, we have 3,900 branches. Fast forward today, we have 60,000 people. And fast forward today, we actually have about 10 to 15% bigger company in terms of consumer checking accounts. So how was that accomplished? Digitization. So right now we're down to 14% of checks are deposited branches. Back then it was 50%. We're with the Erica has now got 1 billion interactions from the time we introduced it a few years back. Think about that saving them calling into a call center or and using the things. Think about the way we can help people with fraud and by giving them notices and our digital is and getting it all to blend as a system is great work done by Dean Athanasian and his team.
Brian, I suspect that most Bloomberg members of the